This is Cobra 3. It is one of our top strategies on the month. It's up around almost 3K, but in this scenario, we're taking a look at a much bigger stop loss. The stop loss for this strategy is $600 per contract by default. We're going to look at those results in a minute. With this setting, it is at $3,000 per contract. So we are not trading this. This is the benefit of hindsight and how you could potentially adjust in the future. This is up on a theoretical basis. Had you used that sort of stop loss, it's up 26K on the month, just this month alone. And let's take a look at that. So 26,400 in February, up 7,000, and you see this huge spike up. Huge volatility can be scary, can provide opportunities, but you definitely have to use much bigger stop losses. And in this case, you have to use a 60-point stop loss in the E-mini NASDAQ, which is, or no, not 60-point stop. It's a, I was thinking of the E-mini S&P. For the NASDAQ, that'd be 150 points on the E-mini NASDAQ. So you see, take a look at these trades, and then I'm going to go back to the default setting. I've also tested a $2,000 stop loss, which would be up 11K on the month. So $2,000 stop loss is not as bad. This one was a loser, lost 3K there. Winner, winner, that's a loss. Winner, winner. These are some big winners. This is an end of day exit, so it wasn't stopped out. Let's see. This was also an end of day exit, so it wasn't stopped out all the way at the $3,000 mark. So that's the benefit. Sometimes is you can lose less with a bigger stop loss because the market comes back down and then you exit at the end of the day. So this is a big winner. That was a big winner. That's stopped out for 3K. So let's look at the percentage winners on this as well. 10 trades, 70% profitable, 6.04 profit factor, 26,460 on the month. This is an adjustment you could make. I want to show you the total performance summary for this, 56,240 going back to 2014 and $10,045 drawdown with this strategy, using a $3,000 drawdown. And from here back, it doesn't look that great. And so I'm going to go back and put our $600 stop loss in, because our $600 stop loss is a very good strategy as well. I'm adding VIX filters to this, so you could trade it less when VIX is high. But this is one strategy that I still like to trade, although $600 is such a close stop in this volatility. So if you're looking at this setup here, I'm going to show you what it looks like. Memorize this. I'm going to change the stop loss to $600, and we'll come back and take a look at it. So still a strong performer. You see this rally forward. We've had a series of losers. This is our last big winner, and some of these trades are losers instead of winners. This trade was a winner. This trade was a winner. I believe this trade was a winner with a $3,000 stop loss instead of a $600 stop loss. You'd be willing to risk that per trade. And so what are the results? $50,955, $5,600 drawdown. And this is with slippage and commission. These results are with slippage and commission. You see the largest losing trade. 625, our stop loss is 600, and you see the $25 slippage and commission included because you see 625. $5,600 drawdown. So this is a top strategy and one I still recommend in its current format. But if you have a larger account, want to increase that stop loss, you could expand that, and you would get that 10 times that amount this month with a stop loss that's 5 times bigger. And in February, it would have been twice that amount. And a $2,000 stop loss would have this number at 11,000. So these are hypothetical results. This is a strategy that is in the portfolio that's being traded, and that's one of the options is using a $3,000 stop loss. And that is one of the things I wanted to share with you today on how to adjust for volatility. You would, hypothetically speaking, you would need a multi-contract strategy so that if VIX is less than 30, you trade, 4 contracts. And if VIX is greater than 30 and less than 50, you trade 2 contracts. And if VIX is greater than 50, you trade one contract. And then you use a stop loss on a position basis so that it doesn't adjust on a per contract basis. And so that's one theoretical approach. I have not fully tested that. That may not be the best way. We may use ranges instead of the VIX. And so the problem with this scenario is if you have to start with 4 contracts, and it requires a much larger account. If you're trading a portfolio of say 30 strategies, your account size needs to be at least 4 times bigger than what we currently have. So that is one way to think in terms of expanding stop losses, decreasing contracts as volatility goes up, and what you might see in your strategies if you test them with a bigger stop loss.